Welcome back to another installment of BTEC for Business. And we, in this video, are going to be looking at the Finance for Business module. More specifically, how we understand the tools businesses use to plan for success. So in this example, Ben thinks it would be a good idea to start a new line of football boots. At first, he thinks he can sell them for £40 and then realise he may have to sell them for £35 to break even into the market. Not great, but never mind. The costs involved are materials, labour, rent, power and insurance. And what I have done is attributed whether they're a variable cost or a fixed cost firstly, written that on. And then next to that, I've calculated the total fixed cost and the individual variable cost for a unit product. And below that, I've given you the formula to work out the break-even point for units. So looking down, if I look at how many pairs does Ben need to sell at £40 to break even, well, he's got saying 15,000 divided by the 20 equals 750 units. Okay, so that's his fixed cost is 15,000. We're dividing it by 20 equals 750 units. But that's at £40. But Ben's had a bad day, really, and he's realised he can only sell them for £35. So things are looking a little bit less rosy. He needs to divide that by 15,000 by 35, subtract 20, which is 15. So he will need to sell 1,000 units going forward. So moving on to a couple of other questions, we're looking at how we would define a budget. Now, a budget is an estimate of income and expenditure for a set period. And it's integral to any business that is successful. So what is that purpose of that budget? Why does it help to make a business successful? The purpose of a budget is to plan, organize and track and improve your financial situation. So people do personal budgets, household budgets, and obviously businesses are no different. They do budgets as well. So looking a little bit deeper, what is the difference between budgeting and budgeting control? In a nutshell, budgetary control is how businesses use a budget to monitor and control costs and operations. So obviously going forward, they would benchmark what's happening to what they thought would happen and hopefully either adjust or make plans to help them meet those budget requirements. So next thing is we need to define a cash flow. So cash flow forecasting is the process of estimating the flow of cash in and out of a business. A cash inflow, for example, would be a payment by customers. I've just given that. You may well think of something else, but as long as it's money coming into the business, that is a cash. Give an example of cash outflow, payment to suppliers. So you would have to hand them money. That would be money going out of your business or any business. Again, you may have come up with different ideas. So if we look at this cash flow activity, Martin is now opening a small shop selling puzzles. He asks you to help him work out his cash flow, as he needs to know whether he will have any cash at the end of the first 4 months. Martin currently has 15,000 in the bank. He expects the following cash totals to come into the business. In July, 17,000, August, 18,000, September, £20,500, and in October, 21,500. And he has a list of expenses here. And you have to be careful with this because the business rates, it's £15,000 per year, but it's paid in monthly installments. So you need to divide that 15,000 by 12 to give you a nice 1,250 per month. The purchase of stock, and again, this differs across the months. It's not a fixed amount. He's buying different amounts over the period. He's planning to do that. And again, the rent is paid monthly, and he's been given a little bit of leeway for the first month in July, £700, and then it goes full throttle to £800 in August. Wages of £10,000 a month, and estimated gas usage for 4 months. And this is quite pertinent or relevant to today, because you think, well, the energy prices where people would have planned, they've gone through the roof. So you can see where businesses have had to adapt to different financial constraints and change their budgets accordingly. So what I've done is I've filled out the table for you, and to be honest, this is quite difficult and takes quite a long time, and you have to concentrate. And if you get distracted, well, you're going to make a mistake. And in the real world, those mistakes cost money. So if you look at it, he started with £15,000 is his opening balance. He made sales of £17,000, and his purchases below is what he's expected, and then his total payments, I've added those all up, and I've subtracted that from the 17,000, added on the 15,000, and now he's got a closing balance of £11,050. That balance goes forward, and if we look at that, he's got total receipts of 18,000, and then he has got total payments of 22,550, and again, his outgoings. He's got a closing balance of £6,500, and you can see a pattern here. His closing balance is looking a little bit concerning. So we put the opening balance back at the top, and you can see we go through the same process. His closing balance is 3,950. We put that at the top, and we end up with another closing balance of £900. In the real world, even you could do this. You'd get yourself an Excel spreadsheet and put the formulas in that you've learned, and the spreadsheet would do it for you. But it's worth noting that you need to go through it, because you may have made a mistake like anybody. And again, like I say, mistakes cost you money, and one way to learn, but you learn very quickly if you're losing money. So going forward, we have some questions to answer on this. Is Martin's cash flow positive or negative? Explain why. Well, I've just given a description of what a negative cash flow is. Negative cash flow describes a situation in which a firm spends more cash than it takes in. And we can, because we've gone and we've produced that cash flow forecast, we can see that his total payments exceed his total receipts. So his cash is reduced and he has a negative cash flow. Not great. Unless he's got a plan to rectify it, or if he might have planned, right, he's setting up a new business and expecting to make negative cash flow over that period. That may be one of those things. Now, I've been asked to make 2 suggestions or 2 steps Martin can take to improve his cash flow. So Martin could target his revenue and costs. So there's one way, there's a number of ways that you could do this. So firstly, he could look for a cheaper supplier. That may be difficult, and reduce his variable cost. The next step, he could increase sales to improve his cash inflow. Again, you might have chosen something else. He might have negotiate a reduction in his rent, for example. But those are the 2 that I thought he could focus on. They're no easy task to get that right. But anyway, so if hopefully that helped and you enjoyed that, and any questions, please ask.